Hey everybody, Preston Brent here with our weekly roundup. This is for the trading week ending Dec 14, 2018. What a crazy month. December is already off to its worst start since 1980. We got to go back to 1980 to see a worse start to the month of December, which, by the way, is traditionally one of the best months of the year. But that just goes to show you that when the markets are ready to sell off, they're going to sell off regardless of what the statisticians say. Before we jump into it, just a couple of quick thinking points that I have I'd like to put across to you. October, we saw when it all began, the worst month since 2008. I mean, as a reminder, it was down about 7.2%. Dow was down about 5.5%. NASDAQ was down just slightly under 10% for the month, almost in correction territory. November was relatively flat, and now we picked it back up again in December, off to the worst start, as I said, since 1980. The VIX was up about almost just slightly under 20% this past week from the prior week. It's up to 21.63. And from a sector performance this week, again, 2 weeks in a row, XLU utility was the top performing, and this week the banks are getting crushed. XLF was down about 3%. The other thing I find very telling is the current PE ratio on a go-forward 12-month rolling basis. It's now at 15.65. That is, I like it getting lower because that just means eventually money's going to start coming in and picking up some of the better stocks. Keep in mind, a year ago today, or a year ago on Friday, the PE ratio stood at 22.64, December 2017, after the miraculous run that we had in 2017. The PE was at 22.64. So we've seen the go forward 12-month projected PE fall by almost 31%. So we're certainly getting a revaluation in the markets, which I obviously like to see. But as we come to the end of the year, I'm sure you will no doubt hear a lot of prognostications from financial publications, investment banks, TV talking heads. Some are going to be right, but most of them are going to be wrong. If any of you have ever been to a Ohio State conference game, the stadium holds about 105,000 people, and you could probably go in there and count on one hand, maybe two, those analysts or folks that get it right consistently year after year after year. Most of them don't. So what are they doing? They're basically looking for bragging rights, because if they do get it right, then they're going to be the king for the next year, and everybody's going to want them on their TV show to please tell them what they see in their crystal ball for the following 12 months. That's kind of how the game is played. I mean, I was looking around at a lot of various publications and investment banks, and I've seen calls for the S&P to go up over 3,200 and finish as low as 2,350 for the year next year. So, I mean, you can't trade that, but that's a huge range, huge dispersion. Everybody's looking for bragging rights. It doesn't mean that they're not smart or not in tune with the markets. It just means everybody likes to put a number out there, and those that get closer win bragging rights and get some money on the side through all of their publicity that they get. So we don't like to play that game. I don't like to play that game. But there's really only two primary issues that's going to drive the markets next year. Two, and only two. It's going to be the resolution of the trade issue, and then it's going to be the glide path for interest rates in 2019. We're going to know a lot about that coming up this week, because on Wednesday we get the quarterly review with the Fed chair, Power Ranger Powell, as we like to call him. And they are going to talk about the dot plots coming up next year. So right now they're forecasting 3. They're forecasting 3. There's a 75% probability of a 25 basis point rate hike next week. That's pretty much all but baked in, but all eyes are going to be on his, what's he going to say for next year? How is he going to do it? And their dot plot shows 3 more in 2019. But however, the bond market is only showing 1 rate hike for 2019. So we've got some push-pull here, but the bond market usually works out to be right. The Feds, I don't think they've been right in the past 2 decades. They're always looking at backwards data, and they're going to be between a rock and a hard place. Globally, it's not very good either. I mean, we've got issues in China, slowing growth in China, Europe, most emerging markets. We got a strong rising dollar. Hell, this past week it hit 2018 highs, the U.S. dollar did. So this is going to put more downward pressure on emerging markets. And then, of course, this past week we had the spectacle in Brexit issues with the vote of no confidence, which Theresa May won. But she's got a tough road to hoe. I mean, that's going to be very tough for her. Um, After the vote of no confidence, which she won, she's now going to go back to the European Union and try and negotiate a better deal, which I doubt they're going to give her much. So now she's got to go back and sell it to the Parliament. That's going to be a big deal. All right, really big deal. Um, so we got that cooking, and then we had the fun popcorn show with Pelosi, Schumer, and Trump in the Oval Office this past week. It was pretty interesting watching those three go at it. With a potential a government shutdown this week, my bet is they're going to push it off to January so that they can all go home and spend Christmas at home. But let's see how that thing works itself out. But these are just some of the issues from a global perspective and a geopolitical perspective. The other issues that I'm watching, the Russell small cap is not in bear market territory. Remember, in an early part of this year, it did get into bear market territory in February, but it's already taken out the February lows. From the highs of this year, all in 1 month's time. I mean, we're about 17.4% off the August all-time highs. But one thing to keep in mind, it's going to be a stock pickers market in 2019, I believe. Just buying an index isn't going to work. Because if you look at the Russell, about 32, I saw a stat, 32% of all companies in the Russell don't even have profits. And that compares to about 10% of the companies in the S&P. I mean, that's why the Russell has a higher beta. It tends to move around a little bit more than the others. So there are some good companies I'm going to share with our members. And we've got some stuff that we're playing right now that's working out pretty good. But I'll walk through it with our members this Sunday evening. The other thing that I've got my eye on, two things actually, volatility and corporate bonds. Volatility is really moving around. It's dancing like I haven't seen it dance for a while. In fact, in 2018, we've had 12 days where the VIX has spiked a good deal in one day. I mean, it's just, we've had more spikes this year than we've had 3 times the previous record. I mean, we've just seen it spike a pretty good bit. So it's causing a lot of these intraday moves up and down. So trends don't hold very well intraday. Even for day traders, it's pretty tough because once you get in, you got to set a very tight stop or you're going to get just stopped right out of it. But it is better for a day trading environment than trying to pick a swing trade over 4 or 5 days because the markets will just flush you right out of the trade. But as I said earlier, the corporate bond market is something I'm also watching because there's about a little over $1 billion, 1.2, 1.4 billion of investment grade debt that's going to be maturing over the next year and the year after. When that debt matures, all of these companies, they got 2 choices, either pay off those bondholders or refinance. And they're going to have to refinance at higher rates because all these things were taken out at almost 0 interest rate. So we're going to see this could impair their balance sheets and their profit margins if they refinance at a higher rate. And they may not have a choice unless they pay off the debt. So I was looking at some debt statistics, and U.S. corporate debt right now is about 46 basis points of the U.S. GDP, and that exceeds the peak that we were at in 2008, 2009 contraction. So given the lateness of our business cycle right now with all this debt that's going to have to be repriced, and there's a lot of investment grade debt that's on the lowest end of the spectrum, that would be triple Bs, that has to be refinanced, and those are most subject to going into junk. And if they move into junk, you're talking about a difference in interest rates from 2.5% to 3.5% to 5%, 4 or 5%. So that would severely impact companies that have to do that. So that's kind of what I'm watching right now. We clearly have a lot of that on the plate. What you see on the screen here is a weekly chart of the E-mini S&P 500 futures. And I've got it on this weekly chart because I want to show you a couple of things. One, I've got a market map on here that basically kind of outlines right here. This is the volume at price, right, over the past 90 weeks, essentially through the end of Q1. You can see these yellow lines here, which indicate where max volume has taken place. In other words, when you've had pretty much market equilibrium. And there's another one that we've got all the way down here, okay? So, and we're sitting right here right now. So we broke the 2603. And we actually closed pretty much right on the nose, 2,625. So the 2,600 thus far has been holding up. Should it break, then it's an easy run down to the 2018 lows of 25.29. Again, this is the future, so it'll be a little bit different than the SPX, which is the cash index. But as markets are always wanting to do, we'll probably overshoot that and come down to this next value area here, which is sitting around 24.40. So this could be a very easy run in my mind, and kind of give what the analysts want and what I'd like to see too, a little bit of a flush out and kind of a capitulation move before we kind of build up into Q1 of next year. So that is kind of what I see here. Now, should this level hold and we kind of bounce around and start moving back up towards the 26 or 2018 open at 26.75, that is almost dead on where all the volume has taken place, the greatest amount of volume. You can see this little green bar right here. This green bar represents a support area in the market, just like in that area there, which is kind of exactly where we're sitting. My lines aren't very straight, but it kind of shows it. And that is where the least volume has taken place. So there hadn't been buyers or sellers. So it kind of dries up down there, which would kind of make sense because, you know, if you look at this little bar right here, this green bar right here, this represents a pivot low on the weekly chart from the summer. And if we take that out, then, you know, we're sitting right on that pivot low right now, roughly. All right. So we're on the net, we're on the lows. And should we break the 2018, you'll see a little bit of a capitulation, I think, and we'll come down here to the, well, because the market's always overshoot, guys. And then we've got this upslope and trend line right here. I showed this last week, but I think it's worth a revisit just to kind of show you guys. So if I back out, and let's just really back out, and you'll see that this line comes all the way back. Again, this is a weekly chart, so that's why it kind of jumbles up like this. But you can see I kicked it off right at the March lows of 2009. And this is the definition of a secular bull market. I mean, during this run, I mean, we've had some pretty ugly times. When we get north of this line, we pull back. When we get north of this line, we pull back, right? The line holds. We got well north of the line here, and we're in the middle of a pullback, and we could get one of these kind of things like this where we find support at that line there, okay? And depending on how fast the sell-off, it could run into a secular bull market. Now, I mean a secular bear market. Understand a secular bear market is different than what we had in 2008, 2009, which was a full tilt boogie bear market. Where it lasted for a year or two. A secular bear market is kind of what we had like in the Russell, where we were only down 20%, 21% for really no more than a month or two, right? And it tends to happen more in the Russell because it's a higher or higher beta small cap stocks. So this is a key line for us, from a technical perspective on the E-minis. I'm watching it very closely. So what would a pullback to this line mean? In a secular market, a secular bear market. I mean, I'm already hearing some of the analysts freak out, calling it a bear market. I mean, people throw the term bear market out very loosely, but correctly. I mean, there's right now about 50% of the companies in the S&P 500 are in fact in a bear market, but don't forget the other 50% that are not. So if we were to just kind of move out and paint a picture here out to, and let me just widen it out like this so that you guys can get a better idea. So if we look at, let me just turn my ruler back on here so that you guys can just kind of get a better idea of this thing. Okay, so the ruler's on. So if we come out here to, let's say March timeframe, by March, Q1 of next year, and we come down and we touch that line right there, right? That gives us about a 21.65% pullback from the highs. That would be by definition a bear market. I would call it a secular bear. Even if we come down and we can hit a bear market right around the 2350 area, we could be in a bear market, but it would be a secular bear in my mind, unless or until we can break this trend line. And then we try a retest of the trend line and then it breaks further. Then I'm not as concerned about it, believe it or not. I'm just not. There's a lot of gloom and doom out there. And generally, when you have everybody on one side of the ship tends to rock the other way. All right. So this is kind of what I'm looking at with the markets here. Now, so let's go back into the daily and just get a close-up view. Let me just get that off the screen here. I got to refresh it. So here's the daily. And if we look at the daily, again, if I were to just kind of zoom out a little bit, you can see all of these market maps. These market maps represent a 90-day window into buyers versus sellers and where all the volume sits, where most of the volume sits. And if I highlight it, because you may not be able to see it, we've got a major volume area here where buyers and sellers were in neutral or equilibrium. That is a fair value. There's another one right here. So there's one that's like just a day step below that one. So that gives us one of these kind of views like this, right? Buyers and sellers. So we know right at that area there, that is going to be a huge resistance zone trying to get back up. There is another one right here, which is just, again, we got two of them right in that area there. And then we got one right here. And then we've got nothing down over here. So we've got this right here would represent a resistance point, and this would be a higher resistance point here. Notice over here, just going back through the end of 2017, there's nothing, right? There is, but I've got to go to a higher time frame to show it because I've only decided to show just 3 market maps on my chart, whether I'm using a daily chart or a weekly or a monthly chart. So this just shows you that we're below a lot of value areas. So to me, we're a little bit more oversold, and that would suggest we can see some bounce. If we look at the MACD down below, you can see some of this divergence building in here. We had a little bit of a bullish divergence on this run here. Now on this one right here, we've already made a lower low. We don't have a cross yet in the MACD. Okay, so if I just kind of zoom out, if we were to get a run up now, we'd get a cross here, but really almost zero divergence from this run down here and this run down here. So this just basically tells me we're in a wide chop. I think the reason why we've been in this box going all the way back, and I talked about this before, it's a sandbox that we're in, really, from this level right here to this level right here. That's the sandbox that we're in. And a lot of it is due to the Fed and the trade tariffs. We're either on, everything's great, or we're not. And you can just see this bounce back and forth in this sandbox, right? As we're moving back up and down. Folks, one of these is going to break, okay? We're either going to break up or we're going to break down. I'm still sticking to my downward bias at this point in time, suggesting a downward break to test the 2018 lows. Now, we've already taken out the 2018 lows for the Russell small cap, but we haven't taken them out for all the others. Now, the E-minis, as you can see, the E-mini S&P 500 is already in the red for the year. Again, the worst December so far since 1980. So we got to go back a ways to see a worse December than this. If we look at the Dow was structurally a very strong chart. We're starting to get very close to a cross in the 50 and the 200 on the Dow too. All right, it's the only one that hadn't crossed yet. And we're testing the lows, the recent lows here in the Dow. If we come back to February of this year, you can see the lows are sitting at roughly 23,000 and 88. It's almost 23,100 for the lows. So we've got a lot of work to do here and a lot of damage repair. So the question is, will we be able to repair the damage before or until we go into a bear market or a secular bear market? Hard to tell. Got to follow the price action here. It's really interesting because this is one of those strange weeks where we've got a bear market in PE ratios and we've got a bull market in earnings. It's really amazing. So the PE ratios, the price to earnings, the valuations of companies have come in, over 30% in 1 year. So that is going to slow the downward ascent here. Because remember, we've still got projection of expansion next year, albeit slower, but expansion nonetheless. I don't see at this point in time a recession on our doorsteps, not yet anyway. But it's not that far behind if because remember, the markets can scare themselves or spook themselves into a recession. I've seen that happen as well. So that's a little bit about this. And of course, I've talked about the rut. So if we look at the rut futures, we made new lows, new 2018 lows Friday, on Friday's closing. But look at the bullish divergence between this one and this one. Okay. So we are getting, and this would be what we call in our group a poor man's bud. All right, because we've got a little bit of noise inside here, but this would suggest that we've had this 3, 4, 5 pattern, Elliott wave pattern, and typically in an Elliott wave 5 leg, you should see divergences in the indexes, whether you're bullish or bearish, in this case bearish. That would suggest an ABC pattern, which basically gives us something like this. After a 5 leg, we have an A leg that's defined, then we have a B leg, and then we have a C leg. And then generally after that, on a daily chart, you get an idea of what's the directional bias going to be, up or down, okay? And the location of the A leg pivot and the B leg pivot and the C leg pivot gives you clues as to whether we're going that way or we're going that way. All right, so it's going to be really interesting how this thing shakes itself out. By the way, we've also got the 3, 4, 5 pattern in the S&P too. And the downside in the, if I were to use Gann and Fibonacci, and I can just do it with just one click here with my software, it'll show me the downside is right there. So we came very close to the downside of about 2560. That was the projected low of the 5 leg. And we, on that day, right? I mean, we came down to 2583 back on the 10th. So that's not to suggest that we can't come down and hit it, because that's what this is suggesting, the 2550 area, slightly above the 2529 lows. Okay. So that's a little bit about what I'm seeing here. And then, of course, if we go to NASDAQ, NASDAQ is really the only one that's still in the green for the year. You can see here's the 2018 open, but it's given up, it's given up a lot. You can see this volume over price. We're sitting on a kind of a low volume area right here. The higher volume area is around 68.51, and then up here you can see these yellow lines giving us the where value is the markets tend to be drawn to these areas. And then, of course, if I really step it out, you can see that the market maps for this year, they all bunch up around where we're priced. So we've got a lot of support underneath. And I believe we're not going to go much beyond the 2018 lows if we do get down there in all indexes, because I just think with expansion still on the horizon, with corporate earnings, I don't see that happening, guys, at least not yet. I do see some more near-term downside, or the odds favor that, and a little bit of a flush out. Okay, but I don't see just yet a bear market in the E-minis or in NASDAQ. The Russell possibly. I've seen the Russell move into a bear market while the other markets were still in a correction mode, but outside of that, no. Now, if we look at Asher, which is China, it's kind of the tracking stock for China. This thing has been nothing, as you can see, but straight down. All right, it's really ugly, 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 ugly. And then, of course, if we look at emerging markets, let me just put that on the screen too. I didn't mean EEM. Here we go. If you look at emerging markets, same thing. Really an ugly picture here for emerging markets. Now, there are a lot of analysts saying that next year the U.S. is going to expand, but the returns on the S&P is going to be around 5 or 6%. And you'll see the gains made in emerging markets, but that's not with a strong dollar in my mind. I believe they're going to try and figure out a way, that would be central bank heads, to figure out a way to reduce the strength of the dollar, but I'm not really sure how they're going to do that. If we get the Feds really going dovish next week, you'll see the dollar sell off and other currencies move up. That'll be bullish for emerging markets, bullish for the euro. Now, if we come down here and look at volatility, as I like to show on my screen, what I do is I color code price ranges in VIX. Different strategies take place at different color zones, okay, for option strategies. And you can see we've been really since the beginning of October in the yellow zone with bouts of not quite red, but kind of a rose colored, like an orange on the stoplight, right? Before it goes all red. And you can see here that we've been in it since October. So quite a period of time. You can see back here in the big February sell-off, once we got up here and then it came back down to more normalized levels, but still in the yellow. We were in the yellow for the same period of time, a long period. So when you have these big bouts of volatility, it tends to stay elevated for anywhere from 60 to 90 days, 120 days. It's common to do this. Now, a lot of people are calling a capitulation where the VIX goes up in this area here. I am kind of one of the few that are not saying the VIX is going to do this. There were a number of instances that drove the VIX up to 50 in February that do not exist now. It just doesn't exist. We had everybody and their uncle was short volatility, and then everybody was scrambling for the same exit back in February. And that caused the liquidation of XIV and just caused problems all over. That's not apparent right now. Granted, we've got hedge funds playing short vol, but not like they were in 2017. Remember, everybody was playing short volatility. Most hedge funds and big money firms were playing short volatility for 2 or 3 years, and it all came to an end in February. So now with the number of shorts out, you're not going to have that short squeeze that we had in February. Can the VIX go up into the low to high 30s? Yeah, absolutely. If we get a capitulation day and it really moves, we can see 1 or 2 days up here. But if it gets up in this area here in the red, I'm going to be selling volatility. I'm not going to be buying it, okay, because the odds favor it coming back down, at least into the rose or the yellow color. It just, as you can see, even with the capitulation here, it only stayed up here for about a week. And then after that, it came way back down. So that's just a trade you can't ignore. If we look at the term structure and volatility, keep in mind the VIX front month, which is DC, is going to expire this Tuesday. So we're going to switch over to Jan, will be the front month. So if we look at the front month vol, we're in a backwardation still. Keep in mind that as we move forward in time, the VIX and the front month vol futures will equal each other, so it'll come down to zero. But until we get to that time, we're still in the red, which says we're in a backwardation. This is a symbol that just measures the front month minus the back month vol, and I've constructed my chart so that if we're in the red, we're in backwardation. That means there's a lot of fear in the market. Anywhere down in the green, we're in a contango term structure, which I don't know how they came up with the name contango, but it just means that it's a normalized, less fear market. Now let's look at back month. The back month term structure, we're in the red as well. Okay. Keep in mind that all of these are going to change, and I'm going to change my front month and back month term structure. This drives VXX. I'm going to have a session early in January, because by the end of January, VXX is going to cease to exist, and they're going to come out with a new ETN. Exchange traded note to replace VXX, because it was a limited duration. I think it was like a 10-year note. Remember, exchange traded notes have limited duration. ETFs don't. And I talked to the providers of VXX, Barclays, I believe, and they basically said it's easier to in the note rather than send letters out and have everybody sign them to extend the note, and then create a new one. Now, in the interim, it'll be VXXB as in Bravo. But then come January 30th back into February, they're going back and they're going to recreate the VXX symbol. So if you hear it going away, well, the VXX symbol is going to stay because it's too popular and they don't want to rebrand the symbol. But just in the month of January, there'll be a lot of noise around the VXX. So for those of you members out there, I'll show you what you got to do in January trading the VXX as we switch over. If you're a non-member, love to have you come in and join us. We're doing really good this year. So let's come over and let's take a look at some of the things that we got here like this. If we look at the treasuries and we look at the bond market, you'll see in the bond market, interest rates have definitely been coming in. I think the bond market, I'm not going to trade in front of the FOMC, but basically the bond market is suggesting higher rates. I mean, lower rates, higher bond prices. And all of the charts that I'm going over with our members suggest the same thing. So I would not be surprised to see the bond market finish higher the end of next week from where we are right now. Okay. And if we look at interest rates, this is the 10-year. You can see, just how dramatically, and let me just put it on a weekly, let's step it out just a little bit. You can see the 10-year rate has come right down to the value area, and that's providing support for us in the 10-year. I don't see it going much lower than this. It may come down here, but it's going to kind of hover around this 2.84% level. Okay, this was suggesting lower rates here as well on the weekly chart with this bearish divergence, this poor man bed on the interest rates. If we come over and look at the dollar, and let's look at the dollar index. 2018 highs here, folks, on this weekly chart. You can see us trying to break out. And if I come over to a daily, just to show you the daily chart of the dollar index, you can see here, it'll probably pull back to this value area around 96.41. But these are highs here, 2018 highs for the US dollar. The euro, I think longer term is doomed. I think near term it can bounce. But Super Mario Draghi's got a tough road to hoe with the euro. It's closing in on its 2018 lows. All right. You can see these value areas and these volume over price. If we step it out to a weekly chart, just to put a little bit more perspective on it, you can see there is a value area right down here around $1.11 to the dollar, right at about $1.12. So that would be a support area to me that I would mark on my screen, right? And just set it up like that and say that would be kind of an area where I would expect to see this hold up a little bit near term. We may get a move back up to this value area here around 116, but I don't really see it going much higher than that, guys. I really don't. British pound is going to be interesting. With Theresa May and the problems she's got, I don't think any politician could thread that needle. And you can see on this weekly chart all of these value areas here, which basically means the pound moves down, establishes the value area, moves down, establishes the value area, and on and on and on it goes. So if you look at it now, we're coming down to this value area that was established back in 2017 of around 1.23. Most analysts are calling for the pound to come down here to the lows of 120 to the dollar, which I think it can go down and go below. I'm waiting for it to get really ugly, and then I'm going to be willing to go long the pound. Right now, I think the near term is where it's at. Okay, I just don't see. And if we come over on a monthly chart to really step it out, just to kind of look at a longer term value area for this thing, I mean, look at this. We're below the monthly value area that goes all the way back to 2011. The value area puts the pound at $1.30, and we're coming down to no man's territory down here where it hasn't been. And if I step this thing out, I mean, look at this. I mean, this is ugly, ugly, ugly. This goes all the way back to 2001, and the prices now are lower because of the Brexit. Okay. And you can see the 2007, 2008 debacle, what it did to the pound. And just as it was starting to break out here, and then in 2016, it gave it all up, and now it's down. So the pound is really gotten pounded, I guess. So I'm waiting for it to get even uglier, and then I'll be more than an interested buyer in the British pound. So members, stand by on this one. If we come over here and look at energy, we've got an energy play on now. I mean, how can we not take that one? It was one that you had to take. Oil, I called the highs up here in oil. All the other analysts, if you guys remember when oil was in the mid 70s, most of the analysts were saying oil was going to go up to the $100 barrel, or at least in the 90s. I was really one of the few out there saying that oil has kind of come to the low 60s, and it kind of overshot that, took out this long-term trend line, and now it's forming a bottom down here. I think we may get a little bit of a lift, but I think it's going to roll back over again. Right now, oil is kind of, after we've gotten through this inventory supply issue and the Iranian issue, which is what drove oil. Now it's a little bit more of a vote on the global economy. I got to sneeze. Excuse me, guys. Right now, oil is more of a vote on the global economy. And you can see going all the way back to about the middle of November, to about 1 month roughly, we've been kind of sandwiched in this tight range right here. One of these areas is going to break. The value area in oil is sitting right around 52.50. This suggests, this Elliott wave count suggests we could get a run up to this area here, mid 50s, high 50s, and then a possible pullback. All the hedge funds and the commitment of traders report have shifted over from bullish to bearish. The other one that we played that, again, this was like trying to, it's one that you just cannot not play. This was the trade that we took in nat gas. Our members are benefiting from this one. I mean, if you look at this trade, you had this kind of thing going on like this, right? I mean, you just had this symmetrical triangle fire off, right? Just like that. And then when we had this break right in this area here, I mean, look at it. It's just broken hard. And you can see the value area. We've got a pivot zone here and a tight pivot zone here. So you might say we've got some support in this area, but the value zone is well below this. Okay. I mean, it's, and this move up here puts some companies out of business. And when you get a commodity that does something like this, that also preys on the elasticity of demand concept, you've got to take the other side of this trade. That's not to suggest that the commodity can't go higher, and it can, but you hedge your bets, and that's kind of what we did with our trade in this thing here in nat gas. And you can look here. Here is the value area for nat gas is at 2.95, and nat gas is at 3.82. So we're already off of this high here around 492 down to 382. So we're down about 1 full point. And that's huge in nat gas language. And the value area is sitting at about 2.92. So one more full point down from the highs. Now, it's not going to make it straight. It's going to be choppy on a go forward basis, but the way we're trading it really assists us in the nature of the trade. So this is just one that we had to take and we had to play. Okay. Now, if we come over and look at the spread between Brent and WTI, the spread is basically flat right now. I was hoping the spread would move up higher once the Saudis cut production, and I think it may still. If it can get up in this area here, I'd be willing to sell the spread. We did that right here, and if you trade Thinkorswim, believe it or not, you can play this move. Up in this area here, it's $1,000 a point. Those that took our shorts in oil back in when oil came from $76, $77 a barrel down, we had members making $25,000 to $30,000 on the trade in a very short period of time. Congrats to them. Ring the registers. We took this trade right here on the spread between Brent and WTI. All you got to do to play the spread to the downside, and it's $1,000 a point, is sell Brent and buy WTI on a 1-to-1 ratio basis. So we played this. Now we're back here. The value area of the spread is around 9.96. You can see during this wild debacle with oil and that big move down, the spread has stayed in a relatively a $2 or $3 range. So the spread is a lot easier to trade in my mind than just being that long the natural, or short the natural, Brent or WTI, because you don't have the wild, wacky, crazy moves that you do in those. But this one allows you to make a play. So this is a really interesting trade here, and as we get more in our option masters for our members, I'll go into some interesting ways, not only to play the spread in energy, but to play the spread in other markets, as well as the yield curve spread too, which I think in the next year or two is going to be where a lot of action is going to be playing itself out. Okay, so that's the energy market. Gasoline was another one that I was short on. If we looked at gasoline futures, look at this thing. My, oh my, I was talking short gas back over here, back in the summer months. And it was doing we had one of these kind of channels that we were going in, and it was fighting the tape, meaning we'd come down here, but it couldn't break. And then finally we broke and just went lower. There were a number of ways to trade this. We had some members trading it, mostly in UGA, Uniform Golf Apple, which is the ETF that tracks gasoline. But in the futures trade, this would have been even more so than oil. It would have been about a $35,000 per contract move. You would have done extremely well. So we've had some good trades in the commodity market, and I like trading these types of commodities this way because you get these moves. Now with this big move here, if I put it on a weekly basis, just to look at where the value areas are, because remember the markets tend to move to the value area. We've got a value area in gas of around $1.52 a gallon. So that would suggest a little bit of an upside. All right, we've got a support area. The risk of a bigger move in gas right now, in my mind, is more to the upside than the downside. The move down has already happened. All right, and the trade is done. This one's already baked, take it out of the oven. But there's going to be other opportunities in 2019 for sure. Let's look at gold. Could this be an opportunity for 2019? Well, I tend to believe this is a weekly chart. If we look at the weekly chart, and you look at this pattern right here, okay, and it comes back to one of these kind of rounded bottoms, and it could be a kind of like a cup and handle kind of play out, right? This would suggest over in this area here, weakness in the dollar, a little bit of weakness in the economy, right? This would be 2019, this would be 2020, and typically, remember in 08 and 09, gold really didn't perform that well because everybody was selling gold to meet margin calls elsewhere. But if we do have a bear market in 2019 or 2020, this will be the most widely forecasted bear market I've ever seen. Keep in mind, 07 and 08, every economist was projecting rosy things leading off to the sell-off in 08. It caught everybody by surprise. Hence, all the margin calls across every asset class, and just about everything fell. Okay. However, in 2019 and 2020, if we do move into a bear market or a rolling secular bear market, okay, then I think gold will do better because you won't have the margin calls because everybody has pretty much built their portfolios to withstand, what everybody's forecasting. So that could make this pattern even more apparent in my mind. Okay, so gold, yes, there could be some upside opportunity. But we've got to see a weakness in the dollar to make this happen. If we come into a daily chart, you can see in gold how we're moving up. We're above the value area here, right? And you can see the next value area is where we hung up here for over a month, right around 1300. Now we're at 1246 right here. But keep in mind, I've got a longer, very choppy 3, 4, 5 Elliott wave pattern. So what does this suggest? If we have a strong 2019, let's say the markets fool everybody. Lord knows that's never happened, right? If the markets fool everybody and have a strong year, and then they push out the potential recession to bear market to 2021, 2022, we could see the gold come all the way back down here again and just sell off with a stronger dollar. The odds don't favor that, but that is another thing that the markets seem to be showing right now on this daily chart with gold. We're not ready yet. I'm not ready yet to declare a bull market in gold. You can see here with this one that we're breaking out. The near-term upside on the value area is suggesting about 1280 in gold. So that's not very much. I'm not ready to jump in all gold just yet. Okay. Um, Same thing with silver. Corn, I think in 2019 can be a really good play. I mean, this is nothing but chop here. Look at this all over the place. A lot of it's because of the trade tariff issues. But if any commodity out of the ags is projected, I think, to do the best, it's going to be corn. I think corn's going to move back up into the fours, up in this area up here. 450 a bushel area back up in this area here. So that would be my call. Not so much wheat. Soybeans is going to be very choppy because of the trade tariffs, but I think if they get that all structured the right way, I think soybean could have a nice run as well. Wheat was kind of ahead of everybody as in the grain market. But you can see here that again, wheat has a little bit more of a steady up progression. I think the bigger move to the upside could be corn, although wheat and soybeans, basically the ag market to me looks better for 2019 than it did 2018. If they get these trade issues resolved, and I mean resolved, not just, Twitter feed stuff, then I think you're going to see a pretty good year for them. Okay. All right, everybody, that's kind of where we're sitting right now. Members, I will see you this Sunday night for our weekly market watch. If you're a non-member, I highly encourage you to come in. We got some great things coming up for 2019. I see a lot of great opportunities for us. Have a really great weekend, everybody. I will see you guys later. Ciao, folks.